Hey everyone, welcome back to the channel. In this video, I'm going to cover my two favorite investing resources from the month of February. The first one is a book called Free Capital by Guy Thomas, and the second is the 2021 Annual Letter to Co-Investors by Rob Vinall. Free Capital discusses the strategies and tactics of 12 private investors based in the UK. And the Letter to Co-Investors, written by Rob Vinall, covers a new investment case for Carvana and the balance between execution and competitive advantages or moats. Please let me know in the comments below if you've read Free Capital or the Rob Vinall Investor Letter. And if any of this sounds interesting to you, stick around and we'll dive into it right now. So this book is called Free Capital, and the subtitle is How 12 Private Investors Made Millions in the Stock Market. This is written by Guy Thomas, who has himself been a private investor since, I think, 1999, I think it said in his bio. Overall, I really enjoyed this book. The basic gist is it covers 12 investors, all based in the UK, who have one way or another become financially independent and have successfully managed and lived off of their own portfolios since varying times, but many of them actually made wealth in the bull market running up to the 1999 dot-com crash. But of course, the dot-com bubble was not the only way that these guys made money. For instance, there are some guys who also invested in real estate and just chipped away at it over time. So the idea of free capital is all about financial independence, really. It's a sum of money minus any living expenses that you have and that you could live off of potentially indefinitely without any outside additions or having to hold down a regular day job or anything like that. So this book covers a couple different types of investors. Some are called geographers, which are top-down investors. There are surveyors, which are bottoms-up investors. And there are activists, which self-explanatory. They spend their times interacting directly with companies and even getting involved on the boards and whatnot in some instances. And then the final category is the eclectics. And the eclectics don't really fit nicely into any one of these categories. They use multiple strategies. For instance, one of the eclectics is actually a day trader, which was kind of an interesting profile to read because that's definitely not the style that I use to invest. So each chapter in this book goes through the investor's backstory. It goes through how they became financially independent, what led them to leaving their jobs. It covers their strategies that they've used to continue to grow their wealth. It covers what their typical day-to-day operations might look like. And for some, it could be sitting in their office all day, mostly reading, maybe looking on message boards. Some of the message boards in this book don't exist anymore probably, but we have places like Value Investors Club or Corner of Berkshire and Fairfax that many of us might be on pretty frequently. So it's a pretty similar style to what I use. They wake up early, they're excited to work. So a lot of these guys, they don't need to work. Obviously, they have free capital and they choose to do so because they love it. It reminds me of Warren Buffett's famous quote of tap dancing to work. And basically, they don't feel like they're working a day in their lives, so they don't even consider it work. And this is a very enviable position, I think, for most private investors, including myself. I'm just still missing the free capital bit. So anyway, each chapter is a bit like a mini Tim Ferriss interview of the habits, techniques, and tricks that all these investors are using to build and maintain their wealth. In one example, there's a guy who coins the term buying the glitch, which is basically looking at companies where they might have had soft earnings or a profit warning, or they were just delisted from a major exchange as sources of potential long-term upside, even if the downside looks bad. If it's a temporary downside, then buying the glitch could be an interesting strategy to go with. But here's an example of one of the charts, basically covering his moves and his purchases during a period with a specific company. So there are plenty of specific examples in this book that could be helpful. I mean, they're dated, but they're all little case studies for how these small-time investors are looking at businesses and succeeding in the markets. And near the end of the book, the author revisits some of these investors up in 2013. Some have done much better than they were at the original time of the interview. And some, have been just okay investors, but all of them are still financially independent, living off of their portfolios. It's just some strategies work better than others. And a lot of these guys do engage in multiple strategies. Even if you're classified as a surveyor in this book, there's one example of a guy who uses a top-down approach when looking for real estate investments, and he holds quite a bit of those. So there's a bunch of different perspectives in this book. It's really exciting to learn about how other small investors have been successful in the markets, and it's something that I find endlessly fascinating. So I really enjoyed this book. One thing I'm really hoping for is that Guy Thomas comes out with a Free Capital 2.0. Maybe, within the next decade or so, we can see how a more modern approach with newer investors, how they are achieving this same success that all the 12 excellent investors in this book have been profiled. I know that might be wishing a lot. Maybe that's up to one of us to write instead. So small investors having great success is endlessly fascinating, and I really enjoyed this book, and I would highly recommend it to you as well if that sounds interesting. Okay, looking at Rob Vinall's 2021 letter to co-investors. The first thing that he puts in all of his annual letters is his performance compared to the DAX, which is an index based in Germany, I think. He slightly underperformed his benchmark in 2021. He returned 15.1% versus the 15.8% for the DAX. That is a small underperformance relative to the benchmark. However, the one thing that I'm sort of wondering about, I don't know the answer to this, is why he compares his portfolio to the DAX versus the S&P 500. The S&P returned almost 27% last year, so it's a significant underperformance for the S&P 500. So that's just one of the questions I might ask Rob Vinall if I were at one of his shareholder meetings. That's something that I'd definitely be curious to learn more about. And anyway, a 15% annual return is nothing to sneeze at. I mean, it's definitely better than the historical average for the S&P and probably the DAX as well. One thing that will be tough probably is the upcoming year for Rob Vinall, at least at the beginning part of this year and maybe in December of last year. A lot of his portfolio companies have basically been cut in half, including companies like Wix. So we might see a bigger underperformance in this upcoming year, but we'll just wait and see. Vinall is one of these investors that has been around for a long time. His fund has been around since 2008, so he surely has some staying power, has some strategies to deal with these hopefully temporary headwinds. So in the first part of the letter, Rob Vinall goes through a pretty detailed analysis of one of his new investments, which is Carvana. Now, Carvana is the largest e-commerce platform for buying and selling used vehicles. They also have other businesses such as a refurbishing business that is still in the works of getting up to speed. Carvana has a 1% market share right now, and Vinall believes that even with a 5% market share in the future, these guys could be massive. Vinall mentions that one of his strategies is to look for companies with emerging moats that are building before they're obvious to everybody else. And he believes that Carvana is definitely in this category. Vinall estimates that Carvana sold probably 40,000 cars in the US in 2021, and the overall used car sales market is somewhere near 40 million cars. So the total addressable market is completely massive. This letter is really great if you want to get an understanding for the bull investment case. He talks a little bit about the strategies the company is using, including improving customer experience to gain market share. But he also believes that this company has moats. And while these might still be developing, as I said, he looks for companies that have emerging moats. He believes that they fall in three categories of moats already. The first emerging moat is its scale, the second is its brand, and then the third is its culture. So the best thing about Vinall's write-ups is that he's really straightforward. Look, he has a section titled, "Why Are We Invested in Carvana?" Then he goes through all of the emerging moats, the scale, the brand, and the culture. And then finally, he winds up explaining the attractive price, which is a prerequisite for making any investment with a margin of safety. So here Vinall ends up with a $96 billion valuation for a company that at the time of him writing this letter was about a $25 billion company, and right now it's actually sitting at about $20 billion in market cap. So definitely, to get a better understanding of where these assumptions are coming from, I would recommend reading this entire write-up. But basically, Vinall thinks that Carvana at scale, selling 2 million cars per year at a $30,000 average price tag per sale, with 8% net margins, will get you to this $96 billion valuation. Now, 2 million cars annually versus the current estimate of about 40,000 per year. It's a substantial increase. So I don't want to say that it's pie in the sky type of valuation or anything, but because I don't know too much about Carvana, but that's something to keep in mind. That's a huge growth runway and growth assumption. So Vinall assumes about a 7.2 billion EBITDA, and after all the expenses, the net income would be about $4.8 billion per year in the steady state. And if you put a 20 times multiplier on that, you get $96 billion. So it's a very rough estimate, of course. There are a lot of moving parts to Carvana, a lot of things that could go wrong, and of course, a lot of things that could go right, because the company is in nascent stage in a giant addressable market. And they are the leader right now, but it remains to be seen if they will continue that trend. So yeah, if you want to get a better insight into what a nice bull case investment write-up reads like, Rob Vinall's letters are always a great go-to. The one thing that he didn't address are some of the major downsides and concerns for Carvana. So I'm sure he has those in mind, or maybe I just don't remember reading about them in the write-up. I was too excited about a potential triple, so we'll see. Some of those downsides include potentially slowed growth, intensified competition, reputational damage from bad sales or bad product. There is a lot to keep in check here. And the one thing is, you don't get a lot of repeat customers, so it's not some sort of recurring revenue. They got to work hard for it. Used car sales, even if it's on an e-commerce platform, sounds like a really hard business to go into, in my opinion. The second part of the letter focuses on this concept of a moat versus execution for a business. He starts off with the famous Ben Graham quote, "Investment is most intelligent when it is most businesslike." And Vinall brings this up because he sees a pretty big discrepancy between the way entrepreneurs view their businesses versus the way investors view them. One of the main differences is that entrepreneurs feel that people are everything, and of course the people are the ones that are executing, versus investors who sometimes don't even consider the people working at the company. Maybe they think about the management, but other than that, it's usually a non-factor. So Vinall actually focuses on the people first, and he thinks that's maybe one of his competitive advantages as an investor, because it's an area of opportunity that others aren't looking at. Sort of relating to this people example, in Vinall's opinion, and from his experience, entrepreneurs value execution over everything. And investors, usually all they care about is, does this business have a competitive advantage? I know I've certainly been guilty of this. I'm not thinking very much about the people at the companies, and certainly highly valuing a competitive advantage over the day-to-day execution for business. But Vinall argues that the best businesses that he's interacted with and experienced are more focused on the incremental improvements of the day-to-day in their business versus thinking about their natural moat or anything like that, and just resting on their laurels in that fashion. He mentions a business called Bechtel, which is an IT services business in Germany that I don't know if it's still in his portfolio, but it has been at one time or another. And he said that basically they outperformed the rest of the competition by simply doing everything better than the competitors. And all this leads Vinall to come to the conclusion that moat is actually an output of incremental day-to-day improvements in the business. It's not just something that appears when a business is incorporated. So as businesses continue to grow and improve, they reap the benefits of having collected more data, knowing more about their customers, having bigger network effects, and benefiting from their scale as they grow. So the bottom line is that competitive advantages come from building a successful business. They don't just pop out of thin air. However, there are a few examples of natural monopolies. Take running a gravel pit or a quarry. There's not a lot of competition for that. And it's really expensive to compete in that area, of course. Vinall has this great quote. He says, "It is like observing a successful business person who drives a Ferrari and arguing that they are successful because they own a Ferrari." So I definitely think that there's a lot of truth to what Vinall is saying, and it might even be pretty evident that that moats are an output, not an input. But I think it's an idea worth revisiting and keeping at the top of your mind. All in all, there's a delicate balance between execution and the competitive advantages, because most industries are constantly changing. Capitalism is so brutal that the minute you step off the gas in a lot of industries, you're going to be eaten by another competitor. So it's super important, especially in those areas, that the businesses prioritize operational efficiency so that they continue to not only reinforce their moat, but hopefully grow it into the future. So operational efficiency isn't everything. Competitive advantage isn't everything. It's a symbiotic relationship that I think both are probably needed for a successful business long term. Thanks, everybody. I hope you enjoyed the coverage of Free Capital and Rob Vinall's most recent annual letter to his co-investors. If you enjoyed this video, you may enjoy this video over here that the YouTube algorithm has picked out for you. Thank you so much for watching this all the way to the end. I really appreciate your time. If you enjoyed this video, please like the video and subscribe for more, and I will see you in the next one.